Let's talk about internal controls. Yes, the stuff that sounds boring but can make or break billion-dollar companies. When controls fail, it's not just a paperwork issue, it's a full-blown corporate disaster. For future CMAs, understanding these failures isn't just about passing an exam, it's about learning how not to become the next headline. We'll dig into real stories: Enron, Wells Fargo, Toshiba, giants that crashed and burned. By dissecting their mistakes, you'll see the real-world consequences of ignoring ethics and controls. This isn't about ticking boxes, it's about developing the guts to call out trouble before it explodes. The CMA exam is about more than numbers. It's about becoming a leader who protects the truth behind the figures. So, grab your popcorn. This is where accounting gets real. Let's dive into the anatomy of these disasters and learn how to keep history from repeating itself. What causes these corporate implosions? Why do companies that seem stable on the outside suddenly unravel, leaving chaos in their wake? It's rarely just one catastrophic blunder. More often it's a toxic cocktail, a dangerous mix of flawed people, broken processes, and a lack of integrity at the top. These elements quietly undermine even the strongest organizations. Let's start with people. Controls are only as effective as the individuals who enforce them. If those people are motivated by greed, laziness, or simple carelessness, the system is already at risk. Sometimes it's not even intentional. Fatigue, stress, or lack of training can lead to costly mistakes. And if those in charge stand to gain from breaking the rules, you've got a classic case of the fox guarding the henhouse. When self-interest overrides responsibility, controls become meaningless. Next, let's talk about process. Even the most detailed, well-written policies are useless if they're outdated, ignored, or easy to sidestep. Procedures must evolve with the business, or they become irrelevant. Think of it like installing a high-tech lock but then taping the code right next to it. The illusion of security is shattered by poor execution. Finally, integrity. If leadership sends the message that results matter more than ethics, no control will ever be strong enough. When leaders cut corners, everyone else feels justified in doing the same. A bad tone at the top doesn't just trickle down, it floods the entire organization, giving silent permission for shortcuts and questionable decisions. These three factors, flawed people, weak processes, and a corrupt culture, don't just coexist. They feed off each other, creating a cycle that's hard to break. One weak link can quickly infect the rest. Small compromises left unchecked snowball into major scandals. What starts as a minor oversight can spiral into a full-blown crisis. As a CMA, your job isn't just to review the process on paper. You must dig deeper, assess the people involved and the culture that shapes their decisions. Only then can you spot the real risks. Ignore any one of these pillars, and you're building on a foundation that's ready to collapse. True control means strengthening all three: people, process, and integrity, so your organization stands strong. Enron, once Wall Street's darling, later the poster child for corporate fraud. Their trick? Hiding billions in debt using special purpose entities, SPEs, off-the-books vehicles to stash losses. On paper, Enron looked debt-free. In reality, it was a house of cards. The real failure? A toxic culture at the top where executives pushed for impossible targets and bent every rule. The board and auditors were either asleep or complicit, letting conflicts of interest run wild. Internal audit was weak, and external auditors, Arthur Andersen, were too cozy with Enron to challenge anything. The result, every check and balance failed, replaced by mutual backscratching. The fraud continued until the inevitable collapse in 2001. Enron's story is a masterclass in how every layer of control can be corrupted. The collapse of Enron stands as one of the most infamous corporate disasters in history, and it offers a powerful lesson for every certified management accountant. Enron's downfall teaches CMAs that complexity in financial statements and business structures often serves as a smokescreen for fraud and unethical behavior. When things look too complicated, it's not just a challenge, it's a warning sign. If you can't understand a transaction, don't just accept it at face value. Keep digging, keep asking questions, and don't be afraid to challenge explanations. Confusion is a red flag, and your curiosity is your best tool for uncovering the truth. Remember, a toxic culture at the top can poison the entire organization. When leaders prioritize profit over principles, ethical behavior quickly erodes at every level. As a CMA, you must recognize the warning signs of a failing culture and take action before it's too late. Your role goes far beyond crunching numbers. As a CMA, you are a steward of both culture and ethics. You set the tone for integrity and transparency in your organization. Champion the importance of independent, empowered auditors, both internal and external. Their objectivity is essential for catching problems before they spiral out of control. Auditors aren't adversaries. They're your partners in protecting the organization's integrity. Work with them, not against them, to build a culture of accountability. Personal integrity matters more than ever. Many at Enron stayed silent out of fear or complacency, but a few, like whistleblower Sharon Watkins, had the courage to speak up. Their actions remind us that one voice can make a difference. Your CMA certification is more than just a credential. It's a public commitment to uphold the highest standards of ethics and professionalism in everything you do. You'll inevitably face pressure to bend the rules or look the other way. But remember, the long-term cost of lost integrity is far greater than any short-term gain. Protect your reputation and your conscience. Be the person who has the courage to say no when it truly matters, even if it means standing alone. Learn from Enron's mistakes. Protect transparency, question unnecessary complexity, and never compromise your ethics, no matter the circumstances. That's how you become a true guardian of financial reality, someone your organization and society can trust. The ultimate lesson is clear. Integrity is your best defense, your strongest asset, and the foundation of lasting success as a CMA. Fast forward to Wells Fargo, a scandal built on fake growth, not hidden debt. Executives pushed the 8 is great mantra, demanding every customer have 8 products. The result? Employees opened millions of unauthorized accounts, forged signatures, and moved money without consent. The root cause, a toxic incentive system that rewarded results at any cost and punished those who fell short. The process measured how many accounts were opened, not how they were opened. A classic risk assessment failure. Complaints and red flags were ignored or buried by leadership. The board claimed ignorance, but evidence showed they knew. The tone at the top was all about hitting quotas, not ethics. When leadership sets impossible goals and ignores oversight, fraud becomes inevitable. Wells Fargo's scandal shows how a rotten culture can betray millions. Wells Fargo's mess is a warning. Incentives are powerful controls, design them wrong, and you breed fraud. As a CMA, you'll help shape performance metrics and pay plans. Always ask, what behavior does this really encourage? Don't just chase numbers. Investigate how results are achieved. Listen to the data. Complaints, odd patterns, and feedback are all clues. Protect all stakeholders, not just shareholders. Fraud hurts customers and employees too. Your ethics code demands you consider the public interest, not just profits. True control means accountability at every level, especially the top. Don't let executives dodge responsibility for the systems they create. Fixing controls at the bottom is pointless if the top is rotten. As a CMA, push for real accountability and ethical business practices. That's how you prevent the next Wells Fargo. Now to Toshiba, a century-old icon brought down by old-school accounting fraud. For years, managers overstated profits by manipulating percentage of completion accounting. Under pressure to meet impossible targets, they booked future profits today and hid losses. The real failure was cultural, unquestioning obedience to authority and fear of challenging unrealistic goals. Finance and accounting staff became enablers, not gatekeepers. The audit committee was weak, and whistleblowing was career suicide. Internal controls were a facade, easily bypassed by a culture that valued loyalty over honesty. The scandal exposed a system where controls existed only on paper. Even the most respected companies can fall if culture and controls break down. Toshiba's story is a warning. Reputation is not a safeguard. Toshiba's collapse is a stark reminder that having the right tone at the top isn't enough to prevent disaster. You also need to cultivate the right mood in the middle, where most decisions are actually made and enforced. Middle managers, often squeezed by impossible demands and relentless performance targets, can become the unwitting agents of fraud, simply trying to survive in a high-pressure environment. As a CMA, you're more than just a number cruncher. You're the circuit breaker in this system. Armed with accurate data, professional skepticism, and the courage to speak up, you have the power to push back against unrealistic targets and questionable directives. Independence is key. Your loyalty must always be to ethical standards and the integrity of your profession, not to your boss's bonus or short-term gains. Be prepared to deliver bad news when necessary, but do so with confidence, backed by thorough and well-documented analysis. It's your responsibility to ensure that the truth is heard, even when it's uncomfortable. Remember, accounting standards that rely heavily on estimates and projections are especially vulnerable to manipulation and abuse, so always demand solid evidence, question assumptions, and document every step you take. Challenge the numbers, scrutinize the logic behind them, and maintain a clear, detailed audit trail that can stand up to scrutiny. No company, no matter how reputable or established, is immune to fraud. Sometimes, a strong reputation can even breed dangerous complacency. Stay vigilant and skeptical at all times, regardless of the company's image or past success. Trust, but always verify. Your job is to safeguard the trust that others place in your organization, protecting sensitive information and upholding transparency. The public's trust is incredibly fragile. Once lost, it's nearly impossible to regain. So protect that trust with real substance, not just a history of good intentions or past achievements. That's the real job of a CMA, to be the ethical backbone of the organization, ensuring that integrity always comes first. After all these scandals, what's the big lesson for future CMAs? Culture, accountability, and integrity matter most. Controls succeed or fail based on people and ethics, not just rules. Your role is more than accounting. You're a strategic leader and ethical gatekeeper. Your superpower, connecting numbers to reality and calling out fantasy. This takes courage. Ask tough questions, challenge authority, and insist on transparency. Assess the tone at the top, champion independent oversight, and scrutinize incentives. Commit to your professional code of ethics. Let it guide you under pressure. The CMA badge is a mark of trust and responsibility. The stories of Enron, Wells Fargo, and Toshiba are your call to action. Go pass that exam and become a true guardian of financial integrity.